With my experience and your ambitions, let's navigate the world of business, making informed choices and capitalizing on every opportunity. Hello, everyone, and welcome to another episode of Profit or Pitfall. Today, we're diving into the intricacies of a DME healthcare business acquisition worth $10 million. And while I have your attention, we'll also tackle the often debated or discussed topic about 7A versus 504, especially when there's no real estate involved. So I'll kind of do a quick walkthrough 7A and 504. So if you're familiar with these, you're in for a treat. If it's something new, get a pen and paper, maybe take some notes to kind of understand how and why they're different and why the execution of one is better than the other in certain situations. So the 7A loan is the SBA's most popular loan program. It's versatile. It's designed for businesses to purchase almost anything that they might need, and that could include just buying money, working capital, to buying a piece of machinery, or even refinancing existing debt. Now, the 504 is, on the other hand, primarily for real estate and heavy equipment purchases. And you have three parts, and I have an example here that I'll just kind of show you as a deal that I was working on last year, where now this was just real estate by itself, but I wanted you to see the little pie because basically you see there's three parts to it. 50%, so 504, 50, 40, 10. 50% is a bank loan that sits at the bank level. It's on the bank's balance sheet and it doesn't get sold. Then you have the CDC or SBA portion, which is a debenture, which is a fancy name for bond. And then 10% comes from the buyer. Now, for our DME deal, there's no real estate involved. And we'll get back to that in a little bit. But since there's no real estate involved, today's episode will use the 7A loan structure for this acquisition. But I'm going to teach you or show you what I thought was fun about this particular acquisition, and why it's so powerful, because we're using pari passu dollars, which we'll walk through in a minute. So before I jump in, I said DME. Not everybody understands what that is. So I figured I'd just give you a quick walkthrough. DME in the healthcare space is durable medical equipment. And these are long-lasting medical equipment that's prescribed by doctors for in-home use. Think wheelchairs, oxygen concentrators, even CPAP machines. I just finished a 5-year journey of caring for my parents, both who had dementia. And as we approached the end, where they were no longer mobile, we had hospital beds in their rooms, equipment these are non-disposable. They're meant for long-term use. And it's a vital industry, bridging the gap between kind of hospital care and home care. And I've been a primary user of that, having been able to take care of my parents, which my wife and I were glad to do. And now that they've passed, we've returned that equipment, and now we have those rooms where we were using for my parents. Now they're back in order. We're still putting them back in order, but at least you get to return that equipment down the road. So I think what I'll do next is I'll walk you through the capital stack, and that'll, I think, is real important, because you'll see that how intricate this can be in a deal, and how creative you can be in a transaction. So I'll walk you through here, where in any business acquisition, the capital stack is the backbone of any financial arrangement. And it's a hierarchy of finances detailing who gets paid and when. And today's deal is worth $10 million. Okay, and so what you'll see here on the first column is the borrower equity, and that's the foundation. We have this person putting in $179,000 in change, and this is the actual personal cash investment made by the borrower. And what I like about this transaction is that this is little fish buying the big fish. This person is very experienced in this business, but his business is smaller than his competitor that he's buying. And as you have heard in many of my Profit or Pitfall episodes, or in my Friday Formula episodes on Friday, or my No Silver Bullet episodes, I talk a lot about relationships, and so this deal came out of relationships that the buyer had. And so what you'll see is that, one is because he's a smaller business, he has less to kind of offer up because he still has this business to run. And so this is his skin in the game. And when we talked about it, we looked at like, well, that's not going to be enough to make this work. So what he did was he pitched friends and family. And so we have friends and family pooling in a solid $1 million. And what's important about this particular offering here is that this is not a loan, it's a direct contribution. And this distinction is vital. Let me tell you why. Because if it's a loan, then lenders or the bank or the SBA, they see it as an additional liability, which means that when you're looking at your debt service, it impacts that significantly. So this is truly a gift. These are not going to be people who will be in the operating agreement as shareholders. They believe in him. They believe in what he's doing. And so they're contributing this $1 million as a gift. Now, if he decides to do something down the road as a thank you, that's up to him. But in this case, it's really, we have no liability on that sense. So this is cash that's being contributed without any strings attached. Now, like I said, we don't have to deal with any holdbacks. We don't have to keep the loan in reserve until certain conditions are met. By directly contributing, this business avoids that complexity and it keeps the capital stack clean. And it's more attractive to the banks, to the financiers, because if I had to include that $1 million, and if those $1 million, if any person above 20% were to step in, I'd have to look at their financial statement, their tax returns. I'm doing another transaction in the 504 space. There's 5 investors. I'm collecting 5 applications, 5 sets of tax returns for 3 years. That's 5 times 3 is 15. It can get pretty complex pretty quickly. And so let's look at the third column, which is the 7A loan itself. Now, the bank steps in with a loan of $5 million, and as previously discussed, this is flexible. It's ideal for a deal like ours that we're discussing today because there's no real estate involved. And if you'll see, the actual contribution to the transaction for the purchase is about $4.8 million. And then there are some additional charges, including the guarantee, which can actually be built in to the transaction. And so the actual amount is $5 million, but the actual contribution in terms of the purchase itself is about $4.8 million in change. And so this loan is guaranteed by the Small Business Administration. It makes it less risky for the bank, and it offers more favorable terms for the borrower. And since there's no real estate, this is a 10-year term, not 25, which you could get with the 504 program. Next column is pari passu. Now, this is the intriguing part of our capital stack. $2.5 million. If you haven't taken your most recent Latin class, pari passu is a Latin term that means equal footing. And in this context of the deal, it suggests that this part of the loan stands on equal footing with the SBA's 7A loan. And in this case, if there were any defaults, both the 7A lender and the pari passu lender have equal rights to the asset. Now, why would a lender do this? I mean, it's a strategic play. They're entering the deal pari passu, so the lender diversifies the risk. They're making the loan more secure, given the shared risk with the SBA-backed portion. And it's helping these lower middle market deals that are too small for investment banks, like the JP Morgans of the world, and they're too large for traditional banks who are going to max out, and at least in this market where we are today with high interest rates, they're going to be at 50, maybe 65% without the SBA. So they're really filling in a nice gap to make these deals that I would say that are above $15 million and maybe up to starting at 5 and going all the way to 15. Pari passu is a great little tool to have to make a deal work for somebody who maybe doesn't have the cash that a larger company might be able to access. Now, last is the seller carry. That's a $1.5 million contribution. This is where the seller is providing financing to the buyer. And it's not just about easing the financial burden. By having skin in the game post-sale, the seller becomes an implicit advocate for the business's continued success, right? They're going to stay involved for a number of months, making introductions to customers to the insurance companies who are offering the contract. And moreover, it offers an extra layer of legal protection to the buyer. And if the pre-sale skeletons pop out of the closet, the seller is still tied to the business financially, and it makes them more accountable. And there's also some tax burden relief that, since that money will come over a 24 or 36 month period. I have it in this table where it's tied as a 10-year fully amortized transaction, but we can outline in the purchase agreement where maybe there's a balloon in year 36 or month 36 or something like that. And hopefully by month 36 or month 48, the buyer has done very well, and we could refinance into something else that's a little bit more attractive, hopefully where rates are today, which are pretty high. If we can look down the road and hopefully rates have normalized a little bit, I don't think we're going to go back to what we saw just back in 21 or 22 where rates were in the 3s and 4s and 5% range. I still think they're going to be pretty high, but comparatively maybe a little bit more controllable in terms of the actual cost of the capital. Now, if we look at this this table that I made to kind of show you some pretty detailed breakdown of what this is going to look like, right? So I'm using an interest rate of prime. Today it's at 8.5 or 8.25. Well, 8.5. I was at 10.25. And so you see how much it's going to cost for each type of capital. I included an annual financing cost because the contribution hasn't been finalized in this particular transaction. But if you look at the bank loan, the pari passu, the seller carry is about $134,000 a month of obligation that you got to pay back. And however, if you look at the 3-year average net income, now that's the third, very last row there where it says net income 3-year average. And so this is the juicy part, because when you're evaluating any deal, the net income average over a period is a critical factor. Now for our DME deal here, we're looking at 3-year average of net income, and this is pretty robust. That tells the business has been consistently profitable, and more importantly, it plays a pivotal role in gauging the feasibility of the acquisition. With all this capital that's being tossed in, the borrow equity, the contribution from friends and family, the 7A loan, the pari passu, the seller carry, you're looking at ways to make sure that this deal is truly feasible. And so here's the math behind it. Now, do you know how to calculate debt service?
Anyone?
So that's DSCR, right? Net income, net operating income divided by total debt service, which includes your principal and interest. Now with a debt service, if you look down at the bottom right-hand corner of the screen there on the table, the debt service is a ratio of 1.67. It'd actually be higher once that contribution of the family and friends is finalized, where they actually, I want to see the letter that says we're giving you this money. Until I see that letter, I have to include it in the capital stack. But without that $13,000 a month or the $160,000 a year, that number is going to go up quite a bit. So it's even going to be a much stronger transaction, because for every dollar of debt the business has, it's earning $1.67. That's pretty healthy. So the ratio indicates the business net income is more than sufficient to service its debt, its obligations, making this a potentially profitable venture. There's lots of cross-selling that can occur, a lot of strategic ideas that as we've been looking through this transaction, how merging these companies, or at least working together on terms of what the buyer sells in terms of product lines and what the seller does not, is a great opportunity to make each client worth more. So if you look here at the sources, you have the $5 million from the SBA 7A program, the pari passu, the 2.5, the seller carried $1.5 million, and then we have the buyer cash, the friends and family. Now you see here, there's a line item that I put there for SBA built-in fees. I threw that in there because I needed this to kind of balance out, but I also wanted you to see it, because what ends up happening is a lot of times you can kind of put these fees into the transaction where you put it into the loan, which means you're coming out less out of pocket. And these are necessary costs associated with obtaining an SBA loan, because you're getting that guarantee to get that higher leverage point to make the deal work. And if you look on the sales, on the uses, you have the acquisition price, it still stands at 10 million. But if you notice at the bottom of this, it's a little bit more than 10 million because you have all these fees associated with getting this deal done. And so one is, to me, is probably the most important part of this transaction, which is the quality of earnings report. Due diligence is key. $12,000 is allocated for a quality of earnings report to ensure the financials presented by the seller really stand up to scrutiny. And the QOE report is a comprehensive analysis of all the components of a company's earnings. So it's a deep dive into understanding the sustainability, the quality, and accuracy of those earnings. And the main aim is to determine the amount of income that is repeatable, sustainable, or predictable, which can be expected to continue in the future. And that really helps the bank as well as the buyer understand, okay, what am I really buying? Am I buying what they say they're selling? And so one is you have what's called recognition. This is a key aspect of the quality of earnings report. It evaluates how the company recognizes revenue and if it's in line with industry standards and accounting principles. There's non-operating and non-recurring items. These are identified and separated out to ensure that they don't distort the picture of ongoing operations. And then there's expense recognition. It looks at when and how expenses are recognized. It ensures there's no manipulation to inflate earnings. Working capital analysis is a great way to assess the company's short-term liquidity and their operation. And then you look at the customer list. You look at the top 10 customers and vendors and see is there any concentration, because it's really important to understand if the business relies too heavily on a particular customer or vendor. So, you will run into that where it's just like, wow, if this guy loses this one client, this person's out of business. So do I want to take on that risk, or is there a way to maybe adjust the pricing of the sales price to take in account that risk? And then you have your debt and interest expense analysis. And this gives insight to the company's leverage and its ability to service its debt the way it is at the moment. And so you might see some improvement there because maybe you're coming in with a cheaper cost of capital compared to what the company had. And then there's margin analysis. So you're looking at the profitability of the company at different levels: gross, operating, and net. And so why is this important? Well, due diligence in mergers and acquisitions, just a traditional sale or purchase of a business, QOE is a crucial part of that diligence. It ensures the acquirer knows precisely what it is they're buying. Now, if you look at the value, when you get to the valuation, it really provides a clearer picture of a company's financial health and what can influence in valuation, right? So you give the investor confidence because they can really see the transparency, the thoroughness, and understanding of the business financials. And especially if you're in a business that you're familiar with, but maybe your skill set when it comes to kind of the accounting and the financial ratios, maybe that's not your strength. A report like this can really help you see things very clearly and easily. One of the things you'll also notice is in this report, you see risk management. So you see where the risks are, allowing the business to either address those concerns proactively while they're in the middle of the sale, or taking that into account. Let's say you walk into the purchase with your eyes wide open. So when traditional financial statements provide a snapshot of a company's financial health, quality of earnings report gives you that deep dive. You're scrutinizing every aspect of those earnings to provide a clearer, more comprehensive view of a company's true financial position. The next line here is the deal cost. Every deal has its cost. I normally do about 1.5% where I allocate that to various deal-related expenses, public searches, all kinds of things that just kind of get put into that one thing. That number always changes, but normally I'm at 1 to 1.5% is pretty accurate. And then you have the bank origination. The bank's going to charge to, originate their loan internally. I assumed 1%. In this particular transaction, there's legal, they're covering due diligence and other unforeseen expenses. And then there's the capital advisor, a guy like me who's charging to, facilitate the deal. I know how these things run. I know where the pitfalls are. And so I'm guiding the client, making sure that things look correct, and, getting past the obstacles that these deals often run into because something doesn't look right, doesn't smell right. We need to kind of clarify, make sure there's a clear understanding as to what's going on. So there you have it, a capital stack that's carefully layered, balancing contributions, bank loans, strategic financial plays, and a seller commitment. And I see numerous deals, but each capital stack tells a very unique story of strategy, belief, and collaboration. So if you're looking at buying or selling a company, give us a call. We'd be happy to take a look at the business, do some analysis, talk about whether or not the company is really ready for a sale and how you can buy or sell on your terms. Okay? I'm Marcelo. I'm the CEO of Shokunin. Tune in next week as we embark on another adventure in profit or pitfall. Take care.